Therefore, during volatile times, maybe you increase the amount of money that you put in a balance advantage fund instead of in an equity fund. Let's say you're doing a 10,000 rupee SIP in an equity fund and a 10,000 rupee equity in a balance advantage fund. Stop the equity fund SIP and double the balance advantage fund SIP. Obviously, you're going to get suboptimal results if the market shoots up, but at that time you can always restart your SIP in equity fund. Otherwise, if you're very clear that you have a 5-year, 10-year view and you don't you will not worry about about watching television or watching videos which say, oh, now you should come in, get out and things like that, just continue your SIP. But for individual equity investors, it's very important to realize that don't get carried away by a fall. The rise may have been spectacular. I remember the price of Sun Pharma going up from something like 300, 350 to 1200, and then people saying, oh, it's a great buy, it is worth keeping. Yes, of course it is a great buy, it is worth keeping, but it is a great buy now at 600, 700, 900 rather than at 1200, and if you're held on for the last 5-6 years, you could have got terrible returns. So don't get carried away. Have your plan, know why you're investing in equities, use volatility to buy. So right, that's why you should have a plan. Predefine some of your actions, saying at this price I'm a seller, at this price I'm a buyer. Pick up some 10 shares which you have in your portfolio and say at this price I'm a seller and pick up 10 shares which you say I don't have it in my portfolio, but if the price falls below this I'm going to buy. Stick to it, right? So for me that price is something like 320 in case of say Ambuja Cement. I'm happy to buy Ambuja Cement at 320. So I bought at 320, but when it reached 420 very quickly, 415 or 416, it was a fantastic price for me to exit. Then when it came back, I could buy it again. So decide. I was definitely an investor in Ambuja Cement. I had no intentions of selling it because I used it as an opportunity when that Hindenburg report hit, and I used it to buy Ambuja Cement. I also bought some Adani ports, but I've got out of Adani ports. I still think it is overpriced, right? So it's not the business which is a problem, it's the valuation which is a problem. So a volatile market allows you to do that. So first of all, you have a plan. Second, predefine some of your actions, saying these are the companies which I would like to buy. I would like to buy, for example, I would like to buy Reliance at 1999, right? At about 2000 rupees, I think Reliance is a good buy. Am I a buyer at 2200? Maybe a small amount. I'm not in a great hurry to buy, but at 2000 I'm definitely a bigger buyer. Why am I buying Reliance at that price? I do think the IPO of Jio, IPO of Reliance Retail, etc. will come, and that will make that will increase the value, because the PE that the Reliance Retail and Jio will get would be much higher than the PE which Reliance itself enjoys. So that will make more, that will put more cash into the hands of Reliance, which could perhaps go into Reliance Solar or things like that. So therefore, right, so have your plan, execute your plan, make sure that you sit tight. My broker has not been allowing me to buy for a very long time. He's saying the market is just not moving. So I've been trading, yes. So don't think that I have been trading, but I have not been investing. I just don't find enough attractiveness in price to become an investor. Of course, things like Coal India you can always buy to get the dividend, but then I don't see any great upside movement. So when Coal India is available at 2002, 2003, I'm a buyer. At 235, I could be a seller, right? So some of the trading opportunities do exist, but yeah, it's not a great market to be investing. Markets may be more volatile, but you should never worry about the markets or the index. Look at the shares in which you are interested, right? So therefore, it could also happen that you might in some shares buy when others are selling and sell when others are buying. You might just do it. It is an accident, though it is a fantastic thing to say that buy when others are selling and sell when others are buying. To actually implement it is very difficult, but if you make your own rules and plan, you might be able to do it. So some of these things, if you can do, also remember that you will never get your investments perfectly right? So I've always said this, how to avoid polio, take a vaccination. How to create wealth, there is no one single answer. There are very many answers. How to create wealth in equity, there are millions of answers. Do you need to invest in international funds? Do you not need to invest? What should you do? Again, very difficult to answer. We will never get our asset allocation perfect. We will never get our timing right with all shares. Sometimes you'll get it right. Sometimes I'll keep buying some shares, saying, okay, this share is worth buying. There are 2 shares which I am accumulating for the next 10 years. which are I can share it with you. It is Zomato and Indigo. Though both are not currently making any money. Both I think will over a period of time establish, but 2 years later, 3 years later, if the movement is not towards building market share, I might just dump those shares and move on. If some competition comes for Zomato, it's going to hurt. Tata's buying so many aircrafts, it's a bad signal for Indigo as a shareholder. But I hope that the services improve from both the airlines, right? Some of these things, so you keep having a plan, keep implementing it, keep changing it, keep scrapping it, keep coming out with new plan. This is the only way to handle volatility. Build your portfolio slowly, decide what is good for you and do it. Thank you. Welcome to Subramani. This is one of those videos which I want you to watch very carefully, especially for a person trying to live off a portfolio, which means you are in retirement, right? So if you are 50 years of age and retired, or you're 70 years of age and retired, or 65 and retired, it doesn't really matter. Some of these facts don't change. So first of all, you have now reached a stage when you have to understand how to translate your assets to cash flows, right? When you are in the accumulation phase, that is you're trying to accumulate money for a particular target. In this case, we will talk about retirement as a target. All of us are on the same plane, whether you invest in a large cap or a mid cap or any of those things. You're 30, you don't really care what is going to happen because you're going to need this money at 60. Even when you're 55, you don't really worry too much because you know at 60 you're going to get your gratuity, PF, etc., which can be put into some short-term funds which you can use for 5 years. So really the cash flow requirement starts at the age of 65 for most people, and if you're working in some companies which automatically and keep giving you extension from 58 to 65, then your cash flow requirements might start at 67 or 68. So you have a longer runway than others where if they are in MNCs or some other banks, etc., where the retirement age is far more stricter. So some of the topics which you have to remember, first is you do not need too much wealth for retirement. What you need is a retirement cash flow. Concentrate on cash flow, not on the assets. Second, very, very important thing, too many people think that if I have say 5 crores and if I get 8% return on my bank deposits or wherever it comes from, I'll have 40 lakhs of income. I need about 10 lakhs, so I'll have 30 lakhs which I will be able to reinvest. That is not the way to look at how your money should be flowing to you. From wherever you withdraw, you will only withdraw what you need. So if you need 10 lakhs a year, you will withdraw only 80,000 a month. What happens is, because you are withdrawing only 10 lakhs and it has some capital and appreciation coming back, you might end up paying very close to zero tax, right? Another important thing is, if you've got 5-6 crores or 10 crores of investments, don't look at Varishta Bima Yojana and the senior citizen savings scheme. That is meant for people with a much lesser net worth. You don't need to have so many assets. There is no point in having 15 lakhs and some 40 instruments for you, right? It become for 5 crores. It is too much of a headache administratively, and the gap really is not much. So you might as well create your own cash flow. I'm a big believer in the bucket theory. So if you are a retired person, let's say you're 60 years of age and you're retired. So we will talk about this person who needs money at the age of 63. Right, so at 60, so you will put your money into 3-4 buckets. First bucket would be, say, 2 to 3 years of expenses would be in bucket number 1, which will be your least volatile bucket. So you will keep withdrawing from that bucket. The next bucket, bucket number 2, would have some volatile assets. You could have even some balance advantage fund, which could be in your second bucket, and there will be a third bucket which is largely equity and maybe some real estate from where you're getting rent. The rent portion is actually bucket number 1, but the asset is in bucket number 3. So if you have this combination where you have some direct equity and you have some equity mutual funds, then the cash flow of dividend is going to come. That is again part of bucket number 1. The cash flow is part of bucket number 1. The asset is in bucket number 3, but that cash flow will come to you. You cannot choose not to get the dividend. So please understand this difference between dividends from a mutual fund, which is your money coming to you, and dividend from a company share, which is the company is deciding when to pay the dividend. You cannot decide when you want the dividend. dividend, whereas in case of mutual funds you can withdraw. So please understand, it is always worth converting that cash flow from capital gain, because you will pay less tax than income. Don't worry about income, you have to be worried more about cash flow. So how should the cash flow come? Cash flow should always come in terms of capital gain. So if you have invested in debt funds, let's say you're a 60-year-old, you want cash flow in 3 years later, so all the money which is in debt funds in bucket number 1, you should start withdrawing after 3 years, because after 3 years it becomes long-term capital gain, which means you pay 20% tax with indexation. So effectively you will pay something like 12-13% tax, which is much less than the 30% tax which you will pay if you create a 40 lakh cash flow. Don't create a 40 lakh cash flow. All you need is 10 lakhs. You can defer your tax as much as possible. You don't need to pay tax. See, if you are earning a salary of 50 lakhs or 5 lakhs, whatever, you have to pay a tax on that, but your interest or your dividend income can always be converted into capital gain and you withdraw. So you've created these buckets. From which bucket to withdraw, that's a completely different video. But having done this, what happens is some part of your capital is coming back, therefore you're paying less tax. So this is more tax efficient. I've been telling this to very many people. Not everybody understands, but please make an attempt to hear this video again. Converting your income from a regular income on which you pay the highest tax to capital gain is a very, very simple thing. Right now it is allowed. We don't know when it will be outlawed.